Welcome to StokTok's deep dive into Companhia de Saneamento Basico do Estado de Sao Paulo. This is a regulated utility company providing water and sewage services across Brazil's most populous state. As of May 1st, the stock is trading at $33.29. The 52-week range runs from $18.88 on the low end to $35.79 on the high end, placing the current price near the middle of that band. The Relative Strength Index, a momentum gauge, sits at 54.7, which is neutral territory. The 50-day moving average is $30.74, while the 200-day moving average is $25.68, indicating the stock is above both intermediate and longer-term trend lines. Let's work through the fundamentals, scene by scene, starting with a quick business overview. Companhia de Saneamento Basico do Estado de Sao Paulo, or SBS, operates as a regulated monopoly utility providing essential water and sewage treatment services. The company's revenue comes from residential, commercial, and industrial customers throughout Sao Paulo state, with pricing power backed by regulatory frameworks that limit rate competition. The structural competitive moat here is formidable. High capital requirements, regulatory barriers to entry, and the inelastic demand for essential utilities. The StokTok score stands at 35 out of 100, signaling caution. Across the 5 analytical dimensions, valuation scores 0 out of 20, financial health 6 out of 20, profitability 9 out of 20, growth 20 out of 20, and smart money 0 out of 20. Now, valuation. The question every investor has to answer: are you paying the right price? The trailing 12-month price-to-earnings multiple stands at 88.77 times. That is an extremely stretched multiple by any historical standard. The forward price-to-earnings, which prices in the next 12 months of expected earnings, is 17.71 times, a dramatic compression suggesting Wall Street expects a material earnings rebound. The PEG ratio, which divides the price-to-earnings multiple by the expected earnings growth rate, sits at 3.58. A PEG below 1 generally indicates the market is underpricing growth, while above 2 signals caution. This company is in cautionary territory. The enterprise value to EBITDA multiple is 50.47 times, another indicator of elevated valuation relative to cash generation capacity. The price-to-sales ratio is 3.71 times, meaning investors are paying $3.71 for every dollar of annual revenue. In our view, the company possesses a durable competitive moat as a regulated monopoly with essential service offerings and high switching costs. However, our proprietary DCF model suggests the stock is trading at a 651% premium to intrinsic value, a stark disconnect. Wall Street consensus reflects this uncertainty. 6 analysts have a mean price target of $33, with a high target of $37 and a low of $31, essentially bracketing the current price with minimal upside priced in. The most recent quarter, Q2 2025, delivered earnings per share of 0.29 against an estimate of 0.37, a miss. Revenue came in at $11.28 billion against an estimate of $38.09 billion, which represents a significant miss on the revenue line. However, revenue growth year-over-year was a strong 19.6%, and operating income reached $3.83 billion with net income of $2.69 billion. The market reacted with a 0.9% decline after hours. Market sentiment around SBS leans neutral, with insufficient recent news catalysts to drive directional conviction. Based on what we see, valuation appears stretched relative to intrinsic value, despite the near-term analyst consensus price target offering modest support. Moving to financial strength, how solid is the foundation? The Piotroski F-score, a 9-point checklist that evaluates profitability, operating efficiency, and balance sheet quality, registers at 4 out of 9. That is below the median and signals moderate financial stress. The Altman Z score, a model designed to estimate bankruptcy risk, comes in at 2.00, placing the company in the gray zone between healthy and distressed territory. Z-scores above 2.99 are considered safe, Between 1.81 and 2.99 represent gray zone risk, and below 1.81 signal distress. The company sits right at that gray zone boundary. On the debt side, the cash-to-debt ratio is 0.31, meaning the company holds only 31 cents of cash for every dollar of debt. That is lean. Interest coverage, which measures how many times the company's operating income covers its interest expense, stands at 3.24 times. That is adequate but not robust. The company has sufficient cash flow to service debt, but there is limited buffer for deterioration. The current ratio, which measures short-term liquidity, is 1.12, just above the danger zone of 1.00. Debt to equity is 0.95, indicating the company is nearly equally financed by debt and equity. In our view, the balance sheet is neither dangerous nor fortress-like. The company can service its obligations under normal circumstances, but there is limited flexibility for stress, acquisitions, or expanded capital allocation. The gray zone Altman score warrants monitoring. Next up, profitability. Is this business actually making money efficiently? The return on invested capital, or return on invested capital, is 8.29%. Return on invested capital measures how much profit the company generates for every dollar of capital deployed in the business. 8.29% is respectable but unspectacular for a regulated utility with a captive customer base and pricing power. The gross margin, the percentage of revenue remaining after cost of goods sold, is 35.66%. Operating margin, which includes operating expenses, stands at 32.25%. Net margin, the final profitability metric after all expenses and taxes, is 23.53%. That net margin is genuinely strong. For every dollar of revenue, the company retains nearly 24 cents as profit. However, the free cash flow margin, which measures actual cash generation as a percentage of revenue, is negative 12.78%. This is the red flag. The company is profitable on an accounting basis, but is burning cash on an operating basis. This suggests significant capital intensity, depreciation charges exceeding cash outflows, or timing differences in working capital. For utility, capital intensity is expected, but a negative free cash flow margin of this magnitude suggests the company is reinvesting heavily in infrastructure or facing margin compression. Return on equity, which measures profit generated per dollar of shareholder capital, is 17.18%, and return on assets is 7.55%. In our view, the company is profitable in the traditional sense, but cash generation is constrained, limiting dividend capacity and growth investment flexibility. Onto growth. Is this business expanding, and at what rate? Over the trailing 3-year period, revenue growth has averaged 20% annually. Over the past 5 years, revenue growth has averaged 18.9% annually. These are solid growth figures for a regulated utility, reflecting both tariff increases sanctioned by regulators and modest volume expansion as Sao Paulo state's population and economy grow. In the most recent quarter, Q2 2025, the company delivered revenue growth of 19.6% year-over-year, roughly in line with the historical trend. Book value, which represents the accounting value of shareholder equity, has grown at an average rate of 16% over the trailing 3-year period. Book value growth trails revenue growth, which suggests the company is reinvesting retained earnings, but not creating excess returns above the cost of capital. The dividend yield is 0.47%, one of the lowest we cover. That is consistent with the negative free cash flow margin. The company simply does not have excess cash available for distribution. In our view, the growth profile is solid and defensible for a utility, but the pacing is moderate and constrained by the regulated rate environment and the company's capital intensity. Next earnings report arrives on May 7, 2026, which should provide updated guidance and visibility on management's growth expectations. Now let's talk smart money. What institutional capital is actually doing with this name? According to Dataroma, 3 top-tier gurus currently hold this stock. That is a modest number of major institutional holders relative to the index, suggesting the name is not a widely held conviction position among the elite investor set. Looking at 13F filings, which institutional investors must disclose quarterly, only 1.6% of filers are net buyers, meaning greater than 50% of their position is increasing. A figure below 50% signals the opposite: the smart money is cautious or outright reducing exposure. Insider ownership, the percentage of shares held by company executives and board members, is 0.0%. This is striking. Management owns virtually none of the company they oversee, which in our view raises questions about alignment of interests between shareholders and the executives making capital allocation decisions. Over the past 3 months, there have been 0 insider buys and 0 insider sells. The absence of any insider activity, particularly buys during a period when valuation is stretched, offers no confidence signal. In our view, the combination of low guru ownership, institutional outflows, and non-existent insider buying suggests the smart money is skeptical. This is a notable divergence from the growth dimension, which scored highest in the SBS scorecard. It suggests investors believe the growth is priced in and are not convinced the valuation gap will compress. And finally, the verdict. Let's bring it all together. On valuation, the stock is trading at an extreme premium to intrinsic value by our DCF model, with a stretched trailing price to earnings multiple offset by a compressed forward multiple and analyst consensus, offering modest support around current levels. Financial strength is moderate, with the company in the Altman gray zone, adequate but not robust interest coverage, and lean cash positioning relative to debt obligations. Profitability is strong on an accounting basis with a respectable net margin of 23%, but free cash flow generation is negative, constraining dividend capacity and growth flexibility. Growth is solid and defensible at around 19% revenue growth year over year, placing the company above many mature utilities, but pacing is modest and regulated constraints limit acceleration. Smart money is notably skeptical, with institutional investors net sellers, guru ownership sparse, and insider activity absent. The most recent quarter delivered revenue and earnings per share misses relative to consensus, with the market reacting with a mild decline after hours. The setup, in our view, reflects a company with durable utility assets, reasonable growth, and strong operating profitability, but valuation that leaves insufficient margin of safety and institutional conviction. The next earnings announcement on May 7, 2026, will provide critical data on whether management can close the gap between trailing and forward multiples. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on Companhia De Saneamento Basico do Estado de Sao Paulo. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.